I consider myself a systematic trend follower, as far as if you wanted to label how I trade. And that's because I do not pay any attention to, the quote-unquote, fundamentals out there for the most part. And the reason for this is because I want to take a very scientific approach to how I interact with the marketplace. And science is based on things, your observations, but most importantly, things that you can measure, and not making assumptions with information that you can't really measure, you don't know the accuracy of, and that's where a lot of people get into trouble. Is this projector on? I believe that's where a lot of people get into trouble. Is they may have a system that works, a technical system that has what we'd call a positive expectancy, meaning it will make money over time as you run more and more iterations of a trade, more and more trades that you take, it'll make money. But when we start overlaying what we think the world will do or what we think might happen, this is our path to, again, becoming very unscientific, starting to use probabilities that are mixing in with our other probabilities and really getting us off track. So a lot of this has to do, I believe, with people's experience, where they come from, what they know, what's happened to them in the past, and it causes them to approach the markets with preconceptions about how things should be. And the best thing that you can do for yourself in this business is wash all of that away and really focus on, okay, what can I measure, what can I control? And that gets down to, how much risk you want to put on a trade, how you interact with the marketplace, and being very, very disciplined and regimented with how you do this. And so this is why we use VantagePoint as a tool, because it really has all the pieces here to make sure that we stay very regimented, create a process and a system, and as long as our interactions with that system are consistent, we'll be able to pull out the high accuracy of the software to our advantage. And that's about the only thing that we've got that we've really got a good probability with. We can anticipate with a high degree of accuracy markets in the very, very short term through technical methods. But the further and further out in time you go, the sloppier this all gets. It's really very similar to weather forecasting, where those forecasters can figure out, hey, the next 2 or 3 days, we can get really, really close on this. We can tell you what is likely to happen, but they can't tell you anything a month out in time. They can't tell you anything 2 weeks out in time, and we're starting to get a lot of people saying things that are going to happen 100 years in time. So I try to make none of these assumptions on how the world works or what's going to happen, and that's the best thing to really keep you on track and doing the right things. Now, I'm going to spend probably about 20 minutes or so here just going through some of these slides and more about how we want to think as traders, and then I'm just going to go into the software and show you exactly what I do and really more importantly why I do these things. So what is the problem? What are we really dealing with trading and having to put on these trades and deal with? Well, these are just realities, and I think no one could really argue with any of these statements. We live in a world that is constantly changing. You look at how the world operated even 10, 20, 30 years ago, it's never going to be like it was, and it's always going to change and be a little bit different. So we really have to embrace the fact that we need to be adaptable, flexible. The world will change. And getting stuck in any belief systems or way you want to view things and being too rigid will not be very helpful to you. We live in a world that's highly unpredictable. That's kind of what we just went over, that we can get high levels of accuracy of what's going to happen tomorrow, maybe the next day, but the further in time we go out, the more variables and unpredictable things interact with that, and it all becomes a mess. So let's focus on really the short term as far as how we deal with our trading. That's going to get more into the management techniques when we get into the charts and everything. Now, emotional stress causes people to practice poor judgment and doubt. I put in parentheses duress here, because duress is actually a criminal defense. Because if you do something under duress or make a bad decision, we legally as a society recognize that you will make bad decisions under periods of stress. Now, the reason for stress and the reason that we feel certain ways when we're in the markets or trading is this is how I view it, is a very mechanical process. All of you guys out there and women are filled with a bunch of serotonin and cortisol and a lot of these emotional hormones that cause those feelings in your brain, in your gut. These things that we call emotions are just chemicals running around your body and moving around. Now, some of us are a lot more neurotic than others, right? Some of us, a little thing happens and that cortisol shoves into your brain and you freak out and you can't even think straight. Others, could take a 60% drawdown and probably not even feel it. I actually doubt there's that many people in the room here that can deal with that, but that's a lot of the best traders are like that, who get the really big returns, very low cortisol, not very neurotic. Now, how I see it, any mechanical process can be hacked. And that's what we want to do, is we want to intervene with these chemicals, these things that however our bodies are, and we're all sort of a different mixture, a different bag. We're all different. So we want to be able to understand ourselves if we really want to intervene in that process. If we want to make sure that we stop making bad decisions under duress, we really need to understand yourself and how you respond in these situations. And in a lot of ways, that takes just experience and practice and testing, and experimenting. So again, these sudden unforeseen events, that's what really kicks in those chemicals and makes you make those bad decisions. Now, who thrives in the marketplace? Man, I've spent so much time modeling the best traders out there. And because of my experience with this company, I've been very, very fortunate to talk to guys like Larry Williams, Ralph Vince, Jack Schwager. And when you understand how these people think and you listen to them talk, and I've listened to literally thousands of interviews, read written interviews, you want to model these people. And the best people in the world, the guys making the ridiculous returns, in my view, they do it this way. They don't try to assume that they know everything that's going to go on, and they don't know, what company is going to be great and all this other stuff. They have a system and a process in place. And even if you talk to someone who's like Warren Buffett, who everyone looks at as like a fundamental investor essentially, he has everything down to a process. He has everything down that's systematic for him. It may not be expressed where you could see it and everything, but for him, it's a system. And essentially, we all operate on a system. You either have one where you check your emotions or you let those emotions be your system. Now, I like to use allegories and metaphors and different ways of viewing things, because I could explain a condition like overbought, oversold, I could say trend, I could say whatever, and we're all going to have different conceptions in our brains of what all these things actually mean. So how I really view the market, and this is kind of getting into the market philosophy, how you're going to view and approach the marketplace, is I really view this as an ecosystem. And the reason for that is it's filled with a lot of different creatures. It's filled with big, giant hedge funds. It's full of individual traders like you and me. It's full of guys making gentlemen's bets. It is full of a lot of different people doing a lot of different things, and they're all different as well. And how I view these things is, the markets are, everyone who participates in the market, they all think they're right. The guys who are going long, the guys going short, the guys buying the options, the guys in there buy and hold forever. They all think they're right. And there's going to be a winner in that battle. You can think about this as like a football game, or go back to like Waterloo. And the battle's going to move this way, and then it's going to move this way, and they're going to push the line one way or another. But all you want to do is lean with who's winning that battle. This is kind of the concept of trend following. All we want to do is measure the market participants and go with them. Everybody thinks they're right, but only one person's going to be right. Or one group, essentially. And even then, we're kind of making assumptions when we talk that way. So if you look at an ecosystem, the ones that thrive kind of keep it pretty simple. You need to eat, you need to make more of yourself, so compound, and you just keep doing that process over and over again. So you look at animals, the ones that can embrace their environment, use the tools in the right environment, those are the ones that thrive. And you've got a bunch of different creatures. Again, think of a bunch of different types of funds, a bunch of different types of traders, and they're all doing different things. And it all is summarized in the price. I remember actually talking to Lou Mendelson, the CEO of VantagePoint, and went to a happy hour where we were the only two that showed up. And I got to talk to him, and he has a fascination with how the markets work, and I do too. And how I view it is it's like the price is literally global consciousness built into that price. So that's what we really want to focus on is really price, and therefore trend following. We'll get into more of these things. Now, an organism in its environment, if it doesn't have the right tools for its environment, it's dead. It doesn't even exist. This is how evolution works, right? If it's not suited for the environment, it doesn't exist. If something can exist, it will. If you have tools, great tools, but you're in the wrong environment, it doesn't matter. You're dead. Whales don't walk around on land. It's not their environment. So much of the animal kingdom is hardwired repetitive systems that, animals don't overthink things. They know what they're good at, and they just keep operating. And so this is how nature works. And this is how the markets work. And the people who know their tools and operate those tools without overthinking it are the ones that thrive in that environment and get the most use out of the markets that they trade, or all the markets that they trade, or their trading system. Now, humans are just like this. The problem, though, is we're in a new environment. I mean, we've been evolving for quite a long time, and we haven't been living in the market world, the financialized world that has sprung up over a very short period of time, and now is getting more and more complex and leaving more and more people behind. And so the problem with our systems is that they're more linked to the animal world. They're more this fight or flight stuff, right? They're more of this, when I feel the stress because the cheetah or the leopard's chasing me, I need to run. And that's what's happening in the market, is everyone's got these old systems of thinking about things, of dealing with the world, that aren't the same environment. We've got rat brains. This is, another trader explains it that way. But, we got animal brains. And we're in a new, very different environment. And we need to really understand what is our edge, what are our tools, how should we use them and operate in this new environment that has nothing to do with how our brains have sort of evolved to deal with these sort of things. So again, I already explained this. Nature can't overthink things. It just simply operates, and it operates efficiently. This is why the world is so plentiful and we see all these beautiful animals and creatures everywhere. There's none of this overthinking things. It just uses the tools, it's in the environment, and it thrives. And it does so, this is probably the most important thing, efficiency. It does it efficiently. When you overthink things, this is where you get the slippage, you chasing trades, you get sloppy. That makes you not be efficient, and if you're not efficient, like any business, you're not going to do as well as the other competitors. The cheetah doesn't go try to borrow characteristics from a pufferfish. The gazelles don't go head-to-head with the lions. Don't be something you're not. Don't jump around and go, okay, this is the way I trade, I figured all this stuff out, and then go try to compete with the day traders, or then go try to compete with the options guys. Or stop, focus on, hey, what am I good at? What works for me and my brain? What can I emotionally handle? And focus. And then once you've been able to focus for a long time and do better, then we can start looking at other systems. Then you can start being a different type of animal, run multiple systems and all these sorts of things. But I think where most people really get it wrong is they don't focus on something with enough determination and really thinking this way of how can I be efficient, learn this process, and operate in the environment that I want to thrive in, which for all of us is the markets. So obviously the gazelle that goes head to head with the cheetah or the lion, he's dead. He's instantly dead. He gets wiped out. He has none of the tools to deal with that. Now humans, yes, we're kind of repeating a little bit, but we're highly evolved. We have these very dynamic lifetimes. We all change careers over and over again, probably throughout our lifetimes. Maybe not some of you guys, but people my age definitely do. And so we're constantly, really changing. And our brains are much more powerful and not as simplistic as the animal kingdom. And again, this is where we really get tripped up. And so going against nature, it means you don't exist. And that's how I feel what goes on a lot in the markets, is people really go against nature and they get wiped out. And that's why who thrives? Those funds that have it all figured out, have it systematic, have a business plan in place to thrive in their environment. So, really, you can think about the markets a million different ways, but I mean, you got to think about this as a business. Everyone is in there to make money, and they are going to try to wipe you out to get it. It is highly competitive, just like nature, just like biology. It's all the same thing. We're all just building on top of it. So again, this is why introspection is very important as a trader. Figure out who you are. Figure out, what kind of positions can you hold in a market. Start trading. If you want to build a system, start trading small. Don't trade gigantically and then have your emotions swinging all over the place. Try to get a feel for what can I handle. Can I sit in a market for 2 or 3 months? Can I day trade? Can I short-term trade and be systematic and not override what I'm trying to do? I myself personally, I trade over very long periods of time. I essentially trade small positions and try to capture very large moves. I'm not a good short-term discretionary day trader. Every time you go in there and start thinking, oh, I'm going to buy this because it looks a little that's when you screw it all up. So for me, I'm a very long-term trader. I'll go over, all of my systems essentially here, but this is the most important part, because we get back to that. There's so many traders out there doing different things, and VantagePoint is not this rigid system that says you have to do it exactly this way. It is an analytic tool that, you could short-term trade with it, you can long-term trade with it. It literally has metrics for almost every time period. You've got a neural index as a 48-hour forecast. You've got predicted highs and lows. That's intraday for the next day. We've got ways to measure trend over different periods of time. So all the tools are there for us to measure the market participants, and that's who we want to exploit in our way. That's the environment that we want to go in there and use our tools and thrive in that market, take what we can out of those other market participants. So I view trading as there's really these two sides to trading. There's our analytic side. That's our charts, our indicator, our vantage point, how we measure volatility. In the animal kingdom, I compare this to like your crab claws, your ram horns. What tools do you have for the job? On the other side of this is our emotions and managing those. And that has to do with our biology. I think the biggest thing that people need to assess is their own personal experiences in their life. If you come from the agricultural markets, you're going to have a lot of preconceived notions about how the agricultural market works. They may not be based on anything really helpful. You probably can't measure them, but you think you know a lot. And that can get you in a lot of trouble. I talk to a lot of traders, and they come from these different industries, and you always see the guy who's like, yeah, I was a few years ago I was managing these pharmaceutical companies, and all he wants to do is trade pharmaceutical stocks because he thinks he knows something about them. But knowing something about a pill is not the same as knowing about how the markets function. So you really have to say, where am I coming from? What do I believe? And in my view, the best thing is to really wash that away and focus on the things, again, that you can measure, and that's what we use technical analysis and tools for. We'll get into. So again, your personal experience, your hormones, your different bag of mix of how you're neurotic you are, your personality type, make those assessments. So we obviously want to leverage those tools that we have and always not try to be something that we're not. And that's where you get into trouble, trying to do something that is not within your wheelhouse, not within your system. There are so many systems out there that work and will produce profits, but very few people that actually run them efficiently. And it doesn't have to do anything with the systems, it has everything to do with the emotions of all this. So in VantagePoint, our survival toolbox, what is our edge here? We need to understand our tools. If we don't understand what this is predicting, if we don't understand, how the tool works, if we don't have a conceptual understanding of these things, it's like, the cheetah with a crab claw. How good is he going to do out in the Serengeti? He's not going to do well. So we need to understand what our strengths are and how we, hunt and eat and find that food. Now, VantagePoint Neural Index. This is, in my view, the backbone of the software. This is where we get that very high level, up to 86% accuracy is derived from the accuracy of the neural index. But it's critically important that, one, we have a process that's going to benefit from that accuracy. Now, how I view it, we have no informational edge. We're all retail guys. So, my degrees in college, I studied economics and political science. And I loved, watching the markets. I hadn't traded technically at all, but just fascinated by, how the world works and trying to figure it out. And I got to a certain point where I could make the pro and con side of just about any argument. You give me a market, you give me a political situation, an economic situation, we get back to that thing that everybody thinks they're right. There's multiple ways to view this. So you get to a point where you realize, I don't have any informational advantage here. If there's extremely good justifications for being on this side and just as good justifications for being on this side, what's the point in trying to assume I got it all figured out? We see this in the world how it works, right? We've got positive, negative, black, white, red, blue, Republican, Democrat, Pepsi, Coke, all state. You even see them splitting into blue and red and black and white. You see it all happening, that everyone wants, there's these two ways of looking at everything. And so instead of trying to get all caught up in that and really burning yourself out, because you're constantly, as the world keeps changing, you're constantly jumping from one side to the other side and trying to figure out all the data coming in, we can just let go of all that. And we can focus on what can we measure, what can we prove, and let's not worry about it. And one of the great benefits of thinking this way is it really dials down the stress in life. If you want to go all your life thinking that you got it all figured out, you'll probably be miserable. So there's a better way to approach the markets. There's a better way, in my view, to approach life. And if we can kind of tap into these things, we can thrive in our environment, which is really all we want to do. So let's get into some of what are our tools, how do they work? More the technical side. Now we're going to start digging in all this. So the neural index is a 48-hour indicator. It's predicting something 48 hours in time forward, 2 days, 2 trading days. I talk to a lot of traders out there, and they want to day trade, and they're making very, very short-term market decisions. And I'm talking like hour candles they're looking at, 15-minute candles. And they're using a 48-hour indicator to do it. This doesn't make sense. Why would you use, if you want to see the accuracy of this indicator, you need to look at 48 hours of time to see whether it's right or wrong. Don't get in that mix of one day and it doesn't do it. The prediction you haven't even seen the prediction yet, and you're trying to operate in the candle. So that's where I see a lot of people going way too short term, and then again exhausting themselves out because again they're in an environment using a tool that they don't understand. So the neural index is a 48-hour indicator, and what it's predicting, so what we need to really conceptually understand, and I can help you when we get in the one-on-one sessions, we can dig into these sorts of things based on how you want to trade or approach the markets. But what it's predicting is a 3-day simple moving average. That's a very short-term, very simple thing to understand, right? A 3-day simple moving average. You just take the last close prices, average them, add them together, divide by 3. Very simple. But this 3-day simple moving average is based off of typical price. So that means it's including the high, the low, and the close into those 3 days. So there's 9 data points going into that calculation. A 3-day simple moving average based on typical price, the high, the low, and the close, divided by 3. Now what we're plotting though is the value of that indicator, which you can go into a live charting service. You can take a 3-day simple moving average of typical price and you can see it on a chart. It's so simplistic. You can do this on graph paper. It's very simple. So we're able to see what that value is today and whether it's going to be higher or lower that 48 hours into the future. Now, you have to, when you conceptually think about this, you could have the market trade. Let's say the market closes at 10. And the next day, the market shoots all the way up to 13. Well, what's happening is that since that high of the day is being calculated in, it's going to pull that neural index prediction higher. The market may close at 9. But because you're just looking at the neural index in too simplistic of a way, you're saying, oh, well, why is it closing down here when it should be up here? But the calculation's right. That high actually caused the calculation to be correct. It's just the framework that you're looking at it in is not helping you understand really what's happening there. And so this is very, very important I would encourage you all to go on your live platforms, take a 3-day simple moving average based on typical price, and see what that value is, because that's what VantagePoint is predicting 2 days forward, whether that value will be higher or lower of that line that's going to be plotted and move forward through time. So we'll get into how I use that indicator inside of really bigger systems to make sure that I get an even better reliability with it. Now, if we wanted to break this apart and look even shorter term as far as the predictions from the software, we could look at predicted strength. Now, predicted strength is essentially the raw value of that neural index. So the neural index is an oscillator. You're all familiar with oscillators. You got a 0 line. Whenever the predicted strength value is above our 0 line, the neural index is at a value of a 1. And that 2-day prediction is essentially. Now, when it's below the 0 line, that neural index is at a 0. But what's very important to understand is the changes in the value of essentially predicted strength. So how strong is our neural index? How weak is it relative to a previous day? Because if you have predicted strength slanted up and then it starts slanting down, the neural index may still be positive, but it's actually telling you that relative to the previous day, you're weaker. So there's actually a prediction of weakness there as far as very, very short term. And so this will help us when I'll go through some charts with you, but when we're looking at the neural index, if we want to break that apart and understand it and how it changes as a trade goes forward through time, it's very important to understand its relative position to a previous candle or a previous day. And so how I view predicted strength is even the slope of predicted strength is a shorter term indication. I mean, if you have an upward slope, it's telling you that you're probably going to see buyers from the predicted low level in VantagePoint or sellers from the predicted high. We'll get more and more to the detail. But this is how, if you want to understand the neural index better, I would definitely encourage you to, on your charts, bring up predicted strength and look at its relation to predicted high and low values. And that's where we're getting to the intraday, what's going to happen tomorrow likely in a market. Now I'm going to run through scans. I'm going to build these scans essentially from scratch for you guys, because then we can see essentially this thing built from the ground up. As a trend follower, we measure trend essentially through moving averages. And in VantagePoint, we have predicted moving averages, which is, again, these things are weighted with this data collected from these intermarkets to make these moving averages better, to make them less laggy, get us into these trades sooner so that we can, when you're able to do this, essentially minimize your risk on trades and get much better piece of the move. But these are triggers. When I see a moving average crossover and my setup's there, I'm in the market. I'm not going to debate if I'm long a market. If I'm bullish, get long. So you need to set up systems that get you long the market so that you're taking these positions, so that your actions are guided by these systems. I'll show you how we can identify these longer term reversals with that. And then, of course, we'll go through the scanning conditions for this and how we want to look at things. Now, predicted moving averages, okay, for trend identification, on the start of a new trend and a new trade, it's what I call the initial entry. It'll tell us when we want to start trading an asset. Now, we can trade it moving forward with a lot of different techniques, but for me, these moving averages identify when we need to start paying attention, regardless of strategy. And we'll get into obviously more details. They can also help us identify similar markets doing similar things. Now, I don't trade any particular market. I view all markets as the same. Like I said, every market is a battle of these participants. Someone's going to win. So a commodity is no different than a stock, which is no different than an ETF, which is no different than a Forex pair. It's all the same. Your system is what's going to allow you to thrive in that environment well, but if we really look at how things are working, there are a lot of correlations out there in the big macro picture. So we've got all these different sectors split up in VantagePoint. But the reality is when the gold mining stocks start moving up, they all start moving up. When similar tech stocks start moving up, they all start moving up. Pharmaceuticals, they all start moving up. So in a lot of ways, you don't really have a bunch of different trades there because they're all correlated. So much of the equity market is essentially correlated that way. If S&P is going up, most stocks are going to rise. And the S&P is going down, most stocks are going to fall. It's kind of how it works. So what we want to use these filtering conditions for is to really get an idea of the bigger picture. Because if we're always just so narrowly focused, we're not really going to pay attention to the bigger macro correlations that are moving around there. And that's a big part of VantagePoint. And when you understand what's going on in the gold market and oil markets, you really see these big sort of sector rotations run through. And so that's what you kind of want your system to be able to do for you as well, is identify the much bigger sector rotations, the much bigger moves, because it's all the same trade. It's all going to be correlated, so focus on the bigger picture. And that's why a lot of people get so focused on one stock and they want to trade a few stocks or maybe only 5 or 10 stocks and whatever, and that's fine, but I'd rather focus on, hey, give me the most amount of options as possible and let me focus on the best opportunities and not narrow essentially my opportunities. Because if you've got 5 or 10 stocks and they all go sideways for a while, you're not going to make any money. If your system is a trend-following system and stocks go sideways, you won't make money. So there's a huge, huge advantage for people like me that don't have an informational edge to essentially use the diversification of the markets as that's like the only free lunch you get here. Your ability to choose to play. I come from, when I was in college, I played a lot of poker. And the best poker players, much like the best traders, understand that the guy winning the most hands is not winning the most money. Generally, the people who make the most money play very, very few hands, but it's how they play those opportunities, how much money they're able to extract from those choice opportunities. And the reality is, in the poker world, is it's the art of the fold. It's the art of knowing when to lay those cards down, when to not play. And if I have more and more opportunities that I can go, not playing that one, not playing that one, not, there's one. That's going to make you more selective. So from my view, a lot of people do different things. Like I said, we're all different animals out there. But for me, and from my experience doing this, without an informational edge, your best thing is diversification. Trade any market, long, short, no bias. Question?
The last 2 points on your slide, I think you just tried to explain that, but I'm saying they're contradicting each other.
Okay.
Because I'm looking for the best risk-reward potential, but the higher the risk-reward gets in, a lower rate of return?
Not a lower rate of return, a lower win rate.
Okay.
So when you get those good, 5, 10 to 1 trades, they're going to work a lower percentage of the time. But it doesn't matter. You can win 30% of the time if you're winning 5 or 10 times more than your losses. So a lot of people focus on win rate, and it's really not what you want to focus on. What you want to focus on is how much bigger are those wins relative to the losses. And this sort of gets back to the poker analogy of winning very few hands, meaning most of the time you're losing. You're folding, you're losing your blind, you're losing small amounts though. But when you win big. And that will deliver your profits. Now the problem, and this is why the emotions are tough for people, is you're going to spend most of the time in drawdowns. Most of the time you'll be losing. Most of the time you'll be taking small losses. And that means your psyche is going to start messing with you. It's going to start going, this isn't working. I'm not winning. Haven't won in a while. What's going on? Loss. And right before that big win comes through, they've already hopped onto another system. Because they've already given up, and they're not going to actually see what we call the positive expectancy from what they're doing in the markets. I mean, every system is going to have periods of drawdown. I mean, this is just a statistical game, right? You flip a coin, you're going to get runs of tails. It's not going to be 50-50. It's not going to be tails, heads, tails, heads, tails, heads. It's going to be tails, 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 tails. You're going to get those long runs. And that's where the emotions really come in. But if you can stick with the system, and this is where money management comes in, because if you're betting too much and one of those runs comes through, you get wiped out as well. But with a bigger risk reward, you know, if you're going to go after those big trades, you're not going to win 70% of them. You know, you're not going to win, 70-80% of your trades where you're getting 10-1. I don't see that reality existing in the marketplace.
Well, isn't your system supposed to be telling you when it,
no.
in the short term, when you get out of a trade again?
I'll get into the exacts of the system, but the accuracy, when we're talking about that 85 to 86% accuracy, that is dealing with a very short-term metric. And it's able to predict that metric. And so what we need to do is sort of take a step back and use that metric in a bigger system. And that system can have almost an infinite possibilities of risk to reward and win rates. That clear it up a little bit?
Yeah, I mean, that's...
Like, because VantagePoint...
That's what I go for. I mean, I go for the big wins.
All right. Then...
because that gives me the most efficiency. I mean, it's basic...
yeah, but...
It works, but on the short term, you need a loss containment thing. You've got to be able to get out. You've got to have the thing is something not working. I'm out of here. I'm taking my losses.
Yeah, and we'll get into that and how you want to do that, cut those losers in these bigger time frames so that you can make sure that you're, again, this goes back to David Ricardo, I'd even say go back to like the Medici family and all this stuff, but writing your winners and cutting your losers short. I mean, that is the essence of trading. And so that's what we'll get into is how do we use that neural index to do exactly that? Make sure that we are heavier and bigger on those positions when they're more likely to work in our favor and getting out of that thing when it's not. Yeah, I mean, it's going to be very hard if you're trading with a tiny account to deal with any sort of drawdown. I mean, you're going to want to, we can look at specific situations and get into more of this, but let's just move forward because then we can get into the charts and we can visually kind of take a look at these concepts that we're kind of explaining here. So we already talked about the simple moving average, predicted strength. Now we want to, combine these indicators to really create that system. And really what we want to be using is using that IntelliScan feature to really create this process for ourselves so that we can be doing the same thing every single evening and keeping that rigidity and discipline essentially so that we can get the accuracy of these accurate tools and work them in our favor. These are just some points, and you can take notes when we get into the charts here. But again, it's this combination of indicators that we want to use. And we really need to ask a lot of these questions of, what type of trade are you taking? You're not going to use a tool the same way if you're a long-term trend follower as if you're a shorter-term trader or if you're an options trader. You're going to use these tools differently, and therefore, you really need to understand the context of how your tools interact with each other. You may have a trend moving higher, but you may be using an overbought, oversold tool that tells you that you're essentially overbought at that point. And so when you get these conflicts between an indicator that's bullish and indicators that are bearish, what does that mean in the context of the system that you're running? When we get, like I said, I'll show you exactly what I do here, and then we can visually see a lot more of these concepts take place. And I just have this last quote. It's from reminiscence of a stock operator, but this is the whole struggle here is, we can do all of these things when there's no risk involved, right? People take their simulation accounts and they run them up and they're like, oh man, this is great. I'm going to start trading 4x high leveraged and I'm going to make a ton of money. And then the reality comes is, sure, you can, be a really good shot, but when you've got another pistol pointed at your heart, when you've got real risk on the line, how good are you? And that's what we're really talking about is under those periods of stress, how good are you going to be? And so that's what really is the most important thing, is when those feelings of stress come up and you want to jump off your system or do something else, how are you going to stick to your plan here? So I'm just going to go ahead. We're going to get into some charts. Okay, so let's go ahead. We'll open this up. I'm going to go through, I'll start with just the indicators that I use and how I use them on a day-to-day basis. And then I'm going to get into the scans so that you can understand how I get to those areas before they take off and go. Because obviously, we can look at all these things in retrospect, but that's pointless because we have to have a system and a process to get us in there before that we know, hey, these conditions are set, now's when I should be there. But obviously, you're going to have to understand how I use my indicators and how I think of them. And all of these tools are in VantagePoint. Again, we want to focus on what are we measuring. Very important concept. So I saved all of these scans, or some of these markets. I did this last night. And because my computer shut off, it closed all of them. But I pretty much know all these markets because they all come through the system, and it's what I look at. So we'll start with what's going on right now in the market. And I'll give you some context for all of this. Luckily, I'm quick with this, or this would be a problem. Okay. These indicators you see at the bottom are the Larry Williams indicators. They're premium indicators within VantagePoint. But what's more important to understand are how they work for me, what I'm measuring essentially in the market. What force am I trying to measure and combine these things with? Now, this is Silver Standard Resources, a silver mining company. Not that important because we don't know anything about the gold or silver market. We just trade the charts. Now, the first thing I do want to focus on is let's go to our crossovers here. Let's focus on crossovers. Now, if we're running a scan every single evening, and I scan short and medium term crosses for every market, every single market, every night, short and medium term crosses with matching neural index direction. And the point of this is I'm going to look at a lot of charts, and that's also good to train your brain as to what's going on out there, give you more market awareness when you scan these things every night and look at a lot of charts. But I know, and this is just logic, nothing but logic here, the trades start at the crossovers. That's when trends start. So whenever you go back in your charts and you look and you see a market and you go, wow, look at this trade, where did it start? Started at a crossover, when that trend started to reverse. So if we look at the short and medium term cross here, just on the top part here, there's our short term cross. So that means I at least know that I looked at this chart right here. I know I did. There's no way for me not to. A crossover to the upside with a matching neural index. A couple days later, I looked at it again when it came through there. There's no way I didn't look at the chart. There's no way possible. So when that condition is met, the condition of trend, I want other favorable conditions on my side. And mind you, think of all this in the context of I want to trade long-term moves. I essentially want to get into a market that is going to trend in the same direction for 2 or 3 months going forward. That's really what I'm looking for. I think this is going to be a major reversal, and this thing's going to keep going for minimum or 2 or 3 months before it, after that period of time, it usually fizzles out. And by that time, if it's gone up for 2 or 3 months, I've already made a ton of money on it where I could just essentially lock in a stop at that point and leave it alone and go find something else. But that's what I'm looking for, a big, big move. I don't want to waste my time looking at tiny little indicators, looking at real short term, because I'm going to get a ton of signals like that. And that's going to happen every single day. The markets are going to move up and down a little bit, and these short term signals are going to move all over the place. So I don't want to focus on that. I want to focus my attention on the big, big moves. So the first condition that I want to be met is essentially a condition of overbought, oversold. If I get a crossover to the upside, I know, just from experience here, that if I'm getting a crossover to the upside, after recently getting, this is an oversold signal with this indicator, that crossover has got a better probability of continuing its trend and actually being a reversal and a sustained move. And the reason that I want to find sustained moves is because I know that this can flip on me. I know that this is so short term that I'm not going to base everything off of that. I essentially want to form this longer term bias and then go in with my shorter term tools afterwards. But the first condition after these crossovers, it says, here's a market to pay attention to. Look at that one. I'm going to look at all those charts and I'm going to see, well, which ones have recently not only had this crossover, but have recently gotten oversold. Go ahead.
The bright blue line, single line, the third chart down.
This indicator, that is, it's a Larry Williams Professional Sentiment Index. It is how I use it. The language is, like I'm saying here, is overbought, oversold. It's letting me know when a market has become, in a shorter term period, but essentially overextended. Now,
Opposite then,
of the RSI,
yes.
it's almost yes. Now, okay, so I know that any crossover I get, that condition alone is going to give me more of a sustained move. Now think about running scans on just simply the crossover condition. You're going to get a lot, right? I mean, every night we're going to see, I'd say on average, just on the crossovers, and I'm talking, I probably scan about 1,000 markets. You probably got about 150 to 200 on average each night, and that's to the upside and the downside. Some nights there's nothing, right? Because so much of this is correlated that it's like, all right, 10 markets came through on the upside, or 15, or very small amounts that are easy to flip through. And usually there's nothing there on those days. But you're going to get hundreds of just these conditions, neural index, crossover, upside, downside, you're going to get hundreds of markets there. But you're not going to get hundreds of markets that have also recently been overbought or oversold. So that's my additional filter that says, okay, well, if I'm looking for these big sustained moves, that condition is going to be a better one. So I'm just going to take out, I'm not even going to look at any of the markets that aren't matching essentially my overbought condition with the direction of my trend. And in VantagePoint, this is very, very quick to do. VantagePoint, one of the great things about it is so snappy because they've been working in Windows environment for such a long time that, I mean, you flip through these charts and it's just boom, 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 boom. You can set up your process where this is very easy to identify. Like an overbought, oversold condition is very easy to visually see very quickly. It's either going to be above your level or it hasn't hit it yet, or below your, or whatever. But if it's not there, it's not there. Don't waste your time looking at it. So, when you see these crossovers come through, because imagine we come back to this day here, we've just done these crossovers, we're flipping through all these charts, this should get us our attention. So this is very easy to flip through and go, okay, I'm looking for this, looking for this. You don't even, when you're flipping through, the crossover conditions have met. You've already scanned them, right? So you already know these are all bullish crossovers. I don't need to spend time looking at crossovers. Just focus on this. Am I going to get a match? Click, 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 click. That'll narrow you down quite a bit on which markets have at least that condition met. So, I kind of get back to this is all just logic. This is all just understanding that, hey, when this happens, combined with this, it's better than this. And it allows me to gauge markets and say, why is this crossover better than this one? Why is this an A+ crossover and this is, C- D? Sure, it's crossing, but I know it's crossing and this is only a 2-day indicator. So what am I going to get from that? It may cross and trade for 2 or 3 or 4 days, go sideways, but that's not what I'm looking for. I don't want a sideways dinky market that sure, the prediction is right, sure, the crossover is right, the trend has changed, but I'm not going to get the magnitude of the move that I'm looking for. So when you're setting up your systems, I would encourage you to set things up this way because in my view, you're not going to be a good short-term trader if you don't understand the long-term environment of what's happening and what context of is this a big market reversal? Are these conditions there that we should get a big move? If you just focus so much on those shorter-term things, all that's going to happen is it's just less likely you're going to get the magnitude of the move to have you hitting those shorter-term profit targets because all these longer-term conditions aren't even in place because you're not even paying attention to them. So even if you were a day trader, whatever, I don't care. But if I saw this market here, and I knew that this market came through with the conditions that we're looking at, I would know you're long there. That could be a major reversal. So even if you came in with just short-term metrics, you can look back at these longer-term conditions in the context that they happened in and understand, are we in a major reversal? Is there a possibility that this thing can go not just for the next few weeks, but for months moving forward? So let's back this up a little bit, and I'll do a quick little recap. Trend, short and medium calls, that is just trend. Don't overcomplicate it. That's our triggers. That gets our attention. Make sure we see the market. We want to scan for those every night. Neural index, complementary. Short term, our 48-hour indicator. And our overbought, oversold, and most overbought, oversold indicators, they work in shorter term time periods. They're like 2 to 3 week, and they're highly reactive to price. This indicator is called the professional sentiment index, and the language that I like to use is sentiment is a function of price. If you have a candy bar that's 50 cents and it goes down to 25 cents, a couple interesting things happen. You're not only more likely to buy the candy bar, but you're more likely to buy in bulk. Something to sort of think about. When the price goes up to $1, they're not going to sell as many candy bars. It's just not going to happen. I mean, markets aren't much different than the supermarket. There's still all of these sort of things taking place. And so these overbought, oversold conditions that people use, or you can think of, sentiment is a function of price. As prices move up, sentiment goes lower. When prices go low, sentiment gets bullish. That's just basic market. So we know that as prices rise and accelerate, we know these sorts of indicators will become bearish. It's just how they work. It's how they interact.
Saw your seminar, what was it, 3-4 weeks ago?
Okay.
And you had Harley Davidson in there on more or less exactly these.
Yeah, we can look at that Harley. Harley was one of the stocks I had up here, yeah. And most of that was to do with the long term,
Right, because it's kind of been flatlining and moving up and down since then, so I wanted to know, would you have exited that?
We'll take a look at it. We'll take a look at it with exactly this framework. So let's go ahead and zoom this out here, because what we've done is we've gone trend, 2-day, short term, predicted highs and lows, that sort of stuff, very short term. You see this indicator is going to be more reactive to these price movements up and down over 2-3 week sort of periods. And this bottom indicator that I have here is the electronic market accumulation index. That is a mouthful. But what it's used to do here is understand that when all these other conditions are met, is that really long-term condition met? Is that much longer term? I mean, to me, this is the indicator that lets me know of the major reversals, the sort of 3 to 6 month kind of stuff. And a lot of these indicators, there's the TSI and VantagePoint is similar, but they are unique indicators. But you want something that's going to look at that much longer term picture as well. All we're doing is using indicators, combining these different time frames, and making sure that we have a system and a process that all these time frames are supportive of each other, that we get these magnitude moves, these bigger moves, so we can get those 10-to-1 sort of trades and capture those big moves. That's really it. Now, how I use this indicator, and we'll look at this on a lot of different charts, and then when we get in the one-on-ones, we can look at maybe charts you've traded. I mean, we can look at any chart in this framework and get an idea of why we would have wanted to take notice at certain points and why you just wouldn't want to trade it, why it's telling you don't mess with this. The setup's not there. But how this indicator works, and I'll take some of this other stuff off here, is it works off of what's called divergence. Now, divergence, all it means is, I don't know the exact definition of divergence, but visually, all it is one's going up, one's going down. They're diverging, they're separating, they're spreading. So when I see a condition where price has made a move lower, and this indicator has not matched its behavior, I know something's up over that long-term context. And that again, if I know I'm getting crossovers and all these other things combined, I know, hey, Now's the time to take note of this. We can see how, this sort of works on all periods where, when we're moving lower, we see that, even before any of these crossovers came, we would have seen this divergence starting to come into the market, which can again be an early indication that something may be up here. May want to put this on a watch list. Just with that indicator alone, wait for all that other stuff to coincide before you trade it. But this is a great way to build watch lists, is take this big step back over these big time frames and notice these sorts of divergences happening between price and these sorts of indicators. Now, one thing that's really important, and it's why most people don't make a lot of money trading. Right before a major reversal in the market, things get a little crazy. And you look at it on chart after chart after chart after chart. And it really is that transfer between the weak hands and the guys who are going to make all the money. And so right before this condition and all these things are set, you really see things like this. Hard sell-offs. And this is where the average Joe's losing money. He's going, I can't take this anymore, I can't take it anymore, I can't take it anymore. And the funds are going, I'll take some more, I'll take some more, I'll take some more. And they're loading up. And how this indicator works, it's called it's meant to track those large institutional traders in the market. But the concept is really the same in that when all that panic is happening, it's just when it's time to usually get in there and buy. That's when you're going to get that big 10 to 1, 5 to 1, and so on, sort of risk-reward scenarios. But you see it constantly. And the same thing happens at the top of markets. Markets exploding higher, you see this setup come into play, the divergences, the overbought, and someone's getting in there buying, and they are trapped. And not only are they trapped, it's going to look like that market will hang for a while, and then when it actually makes the big moves, there'll be overnight huge giant gaps on the chart. That's what you just want to avoid as a trader, because that kind of stuff will wipe you out if you're chasing just trend and don't realize these larger conditions are in place and just snaps against you. So not only do we want to use these tools to find these opportunities, it's a very good tool to tell us where to avoid even messing around in certain markets where there's danger. But I look at this on a 6-month chart. You really want to take a big step back. This is the longest sort of time frame thing. And like I said, you're going to see this sell-off and accumulation divergence stepping into the marketplace. And once that trend takes off, that's where all your triggers and everything's going on. So if we put up all these indicators again, we really see what is the setup that I look for? Well, it is, pretty much exactly all these conditions aligned at the same time. The difficulty here is having a process to make sure that you are there, see it, and take action on it. So crossover, neural index, overbought, oversold condition, PSI, whatever you want, longer term divergence. And again, we can look at some TSI examples and we get in the one-on-one, things like this. But whatever tool you want to use, it doesn't really matter. The most important thing is that you have a system to measure these things and a process to make sure that you're there for when these big moves come through. Because it allows you to take a small position and capture a big move. And therefore, if any given market, you don't want to get too heavy. You don't want to get too big in any one market at one time, because that's where you really get caught and where you just get into situations where you lose far more money than you should on a single trade. So what this allows you to do is keep running these scans. You're running it on so many markets. You're going long, you're going short. You've got a lot of non-correlated things going on, but non-correlation with a positive expectancy. So it's not like some big market hit that's going to hit you. The S&P drops 5, 6, 7%. You've got some shorts that came through your system. Maybe you take a few longs one week, will come through. Then the next week you see a couple short positions you take. Then the next week you've got a few longs. But you still have those trades you took 3 weeks ago on, because you can get into them, lock your stops in, and ride them. This might be a good time to look at Harley Davidson. So silver standard, that came through on a few weeks ago, right at the end of last year. So let's take this framework and look at a stock that, from what I understand, has not been doing so well. Now, I'm not in this market because it isn't a perfect setup, and I preserve, for perfect setups. But you could see the conditions really taking place in this market. Most notably right here. So if you're only running scans for crossovers to the upside, right, and that's the only condition you're looking for, and the only thing you've got in, you're just looking for crossovers, matching neural index, and you're going to trade those markets, well, that's fine, but look what you're running into. This would have been a crossover to the upside, your neural index would have matched, and you would have been like, all right, this is going to keep trending up. But without looking at those other conditions, you're getting yourself into some dangerous situations. And this is why this multiple time frame sort of approach is so important. And then we'll get into the scan and the process so you can make sure that you're able to identify these things early. But when these crossovers come through the software for somebody like me, I'm looking at this and going, this is a great opportunity to short the market. Whether, through options, just trading over the short term, whatever you want to do. But the most important thing is if you don't understand that long-term picture, you're going to find yourself in dangerous situations because there's not much meat here for you. And the shorter and shorter term you go, the more slippage you're going to get, the less efficient you'll be, the more you'll want to chase markets and do things you shouldn't be doing instead of taking a step back and going, hey, what's the bigger picture here? Now, a technique that I do that's actually quite interesting, and I think I'm the only person I've seen that does this. And actually, let's use on silver standard because that'll be a more pure example here. When you see these lower conditions aligning at the same time, and we can narrow this down to a specific date because there's going to be a specific day that you hit your overbought, oversold condition for the first time. That'll be on a specific date. Once it crosses the barrier, that's the day. What was the close on that day? That's the day you essentially got, in this case, oversold. If you see an oversold condition in the context of your longer time frame divergence, what I like to do, and this is great for your live charts and to help you just know what is the longer term bias on that market, I go to that specific day, go to the close of that day when these conditions aligned. Now mind you, we're not even looking at crossovers and neural index, none of the VantagePoint stuff here. We're looking specifically at these longer term conditions, and when those both two things line up at the same time, it's very rare. It doesn't happen very often. You're not going to see a bullish divergence and then a bearish divergence within a month of each other. We're looking at these 3 and 6 month time frames. So we know this is very, very, very rare. But when it happens, it's so important to take note of. And so what I do is I come into a market like this and I make this line, I make it fat because both conditions are met, not just one, but both. And I make it green, essentially the bias direction of the market. And now trading this forward, because I have a long-term bias with this setup for 2 or 3 months going forward, I know there is no reason on earth to be short this market below that price. That's just the language I use and tell to myself. But there is no reason to be short below that price when all those conditions align. That is danger, danger, danger situation. So all these guys riding this trend who are going, oh yeah, that's a great time to short. No, it's not. The trend certainly is down, but once you hit there, you knew that something is wrong with those short opportunities. Once the market gets essentially overbought, because you see, we know that our overbought, oversold is a function of price. As price moves up, it'll become bearish and vice versa. I know that this is a sell signal, essentially. But what context is it happening in? It's happening in the context of a major reversal. So this is not a sell signal. This is a management signal for me. This is telling me, take a little bit of profit. We may get a little weakness above that price level, but that's where we want to be very conscientious as far as taking a little bit of profit, putting some in our pocket, and then we can sort of, again, go into the market with that context of we want to make sure we're in for that long-term reversal. Well, we see what happens. For the next short term, we get a little bit of selling. We're trading below that level. But in the big context, we know we want to be long, and we know we want to be long for a really long time. Let's look at these sort of same conditions on Harley-Davidson. Well, we didn't quite get it there. Got pretty close. Here it looks a little wonky. But had we gotten a sell signal there, that's where our line would have essentially gone. And I see this all the time. I'm seeing it right now in Kraft Foods. We'll look at that one too. Or wait, we want this red. But this happens a lot, and I think this is where when you don't know the big long-term picture, you really get confused. We started to see the divergence here. We almost got oversold. We didn't quite get there, but the sell-off came and we're selling. Whoa, lo and behold, where do we end up again? No reason to be long above that price level, and look what happened. Got there, closed below, gaps down. Because all these longer-term conditions are in place that say we don't want to be buying this thing. Our longer-term bias, because of these longer-term tools, are saying sell the market, sell short, sell options. Usually on these bigger markets, it's kind of interesting. Like you do get a lot of volatility, and therefore the options can help you deal with volatility. Yeah.
Yeah, well, that was exactly that point. Because I went short and still am, but that point where it went above 60 there, that you just indicated, I thought that meant I should be getting out of the trade.
And this is why you're here.
Exactly.
Yeah, this is why, you know, when you rely too much on just the short term, it's going to change. Shorter term indicators are going to move up, they're going to move down, they're going to get you a little bit more emotional because it's harder to deal in those, watching the ticks. I mean, that's where people let their emotions. They watch the market all day and they let these ticks get the better of them instead of saying, what is my bigger objective here? What am I doing? And when I get into any trade, my stops are above the highest high. When I'm trading, because it's just logic. If I'm trading a market reversal and the market does indeed reverse, it shouldn't trade past here. If it's reversed, sure, it'll move all over the place, but it shouldn't trade up here. You see, it doesn't. It gets right back to that level where all these things really started to coincide and then tanked. Again, we can sort of look at, you know, what is the context of conflicting signals? Well, you see, once we started to get into that downtrend, our oversold condition essentially got bullish. And so in the short term said, hey, below that little skinny line, because I make it skinny because it's only one condition met, right? Here, both conditions are close to met, not perfect, but both conditions are met. So that's my double indication that major reversal. And then when you get overbought, you get a little small signal that says, hey, you may have some strength below this price level. You may have some buyers down there, and certainly that's what you get. But you're messing in this, you know, you're just going sideways within those two levels where you know, hey, there's going to be those short-term buyers coming in, but the bigger picture is that's who we're suspecting to win there. Kraft is a good example of this right now as well. And not only that, but think about it this way. When you understand that this is going on, not only are you not buying there, but you're selling. Because that's a great position for you to add to the position with very little risk. You're going to know very early if you're wrong on something like that. Really quick. It's either going to hit that level and quickly start trading lower. So you get another opportunity to maybe add to your position, do what you need to do. I like to often just have orders waiting at those levels. Because I know, hey, if I'm willing to lose, you know, $600 to $1,000 on a trade, something like that, and I can load up more and keep my stops where I want, that's where I'll add to the position. Knowing that if I lose, I know the risk is capped. I know how maximum what I'm willing to lose on a trade, but I know sort of the levels it should stay within. And therefore, when I look at something like that, I go, that's a great sell level. I mean, you're not going to get that from VantagePoint because VantagePoint just works in a different way. You know what I mean? Like VantagePoint is real short term, focusing on trend. But when you know those levels are there, you know when it's more likely that the neural index or these other shorter term tools are going to be wrong soon. I mean, they're right, you know. Here's the thing, is they're right here. You know what I mean? Like average prices are moving up, moving up, moving up, and then they're wrong once, essentially. There, it's wrong once, but it so quickly corrects itself and goes, bring those shorts back in. If your long-term bias over 3 months is short, and then your 2-day indicator gets short again, then go in and start trading that trend lower. Let's look at Kraft. That's a good one. Do I have Kraft on here? Oh, I'm an idiot. It's Kellogg. See? When you trade this way, you don't even need to know what the ticker symbol is because it doesn't matter. It's a market. A market's a market's a market. It's all a bunch of buyers and sellers. I could be buying or selling milk. It doesn't matter. Take this framework, throw it on here. And mind you, again, I don't know what trades are going to work out. I don't know where I'm going to make my money over any given period of time. You just sort of have to embrace the uncertain, and you have to embrace uncertainty for sure in trading. Okay, so here's what gets the attention. Is that okay? Well, you've had this sell-off. You've got this big long-term divergence, right? Long term. If we zoom in on this, so my line, so the level that we got a sell-off, we got overbought, we see this big longer term divergence. It is starting to get a little wonky, which I'm not too wild about, but long-term divergence, that means that big green line goes there, where all those longer term conditions were set. And look at what the market does. So I bought more right here. Because you got your trend, you got your short-term tools, you say, okay, I can get into this thing, I can hang here, I can be long, take some short-term profits if you want along the way, but if that long-term condition is set, you're likely to see bounces off of that level. And sure enough, it happens again. Now if it fails, that's what your stops are for. Question, and I need to repeat these questions so everyone can hear. Okay, go ahead, yeah.
When you go short term, so you're doing like what, 2 days?
What do you mean?
Well, when you went and then expanded this to spread out and you're looking at the short term, is that where you're?
All that I'm really trying to express here is once that long-term bias comes in, I will keep trading that market long for 2 or 3 months going forward. So I'll take what I call my initial position. When I get my crossover, I take a position. I want to be long this asset, I'm long. Over the course of that trade moving forward, I have these really accurate short-term tools. And not only that, I also have these levels where I know are great positions to add to that position. But I'm not shorting here. I won't short. My bias is convicted long because I've done all the work and the homework to know that's where you want to be long. So behind all this is the risk management of saying, how much are you willing to lose on a trade? So just calculate your entry, where your stop is, and you're going to have a value that comes up. And as long as I haven't exceeded that value, so my stops are well below the low here, as long as I haven't exceeded that risk value, I can add on to that position. If in the short term it's moved up in my favor and I'm near a predicted high for the day, take a little bit off, take some shares off, and then have these orders waiting knowing that if I hit those levels again, I want to be long. But it's just, no matter, it allows you to trade however you want to trade. If you wanted to just buy the market and leave it alone, fine, do that. Just go off the crossovers. If you want to be a short-term trader and trade on 2-day time frames, right? Great, do that, but only do it when this environment is right. Only do it when all those conditions are set that it's likely we get a major reversal or something, and then you can go in, with a shorter-term idea, because what happens is at least you've got that support for those shorter-term ideas, right? Because if you've got all these conditions, it's just likely the market's going to have less likelihood it goes against you, and more likelihood that even in any shorter time period, you're going to actually hit those targets, because over the long term, it's likely you hit the targets, or that you at least move higher. So you've just set this whole framework for, look, however you want to trade. If you want to trade options, how I trade an option is probably not how most people trade options. I only trade options when it really makes sense. I go and look at the options chain, look at how much premium am I paying? What am I getting for how much size I can hold of a position? So for something like this, because I had like, say, like a 2 or 3 month bias, you would want an option that doesn't expire for 4 months. I mean, you can put the expirations way, way out there, because in the long term, that's what I want. That's my position. I'm expecting this major big reversal. So what's going to happen is as that market trades or moves forward, I mean, you're going to have to pay a lot of premium. The spreads are usually going to be big on those options that are way out there. But it helps you deal with the volatility. So let's say you're a trader that just gets really neurotic and you can't hold on to your positions. What you would want to do is probably trade these long-term options so that you don't get out of your position and you focus on just that longer-term move. But there's like infinite possibilities of things you could do here, because you could not only take that option and have a limited amount of risk, but let's say you still have, you know, a few $100s to risk. You can then go in and buy 50 shares, buy 100 shares, take a little piece out of the market and still keep that option for the long duration of a trade.
Use that then to, like when you get those aligned and you think the market's, of course, turning,
Mm-hmm.
would you use that to sell, like for example, deep in the money puts and buy the futures?
I'm a very directional trader. So I mean, I'm just going to buy puts and buy and sell puts or calls. Yeah, and that's all it's for. I'm paying the premium for a purpose, meaning I'm paying, because all it is leverage, and the premium, you're buying something. So what am I buying? I'm buying a way to deal with excessive volatility. So if that's my MO for the next 3 months, I know there may be a lot of volatility here, and I just want to make sure I hold that position and limit my risk. Great reason to buy an option. I mean, that's really about it, is when I know I want to take a long-term position and I don't want to deal with the volatility, just buy it out. And then you've limited your risk and you can just forget about it. Because what happens is, with all these conditions in place, it's very unlikely the market pushes against you violently. So let's say your option doesn't expire for 4 months, and now we're 2 months, you know, we've gone maybe a month, 6 weeks, and the trade's not working. What happens is it's more likely that you're just running sideways for a while. With all these conditions, it's very unlikely that the market is excessively going against you. And so what ends up happening is that time decay, because the option is so far out, doesn't really start eating into that premium. So even if I'm wrong and the market goes nowhere, or my crossovers get negative and start going against me, I can just get out of the market with a very small loss. The option price hasn't changed very much because it still has a lot of value as a hedging mechanism for a lot of people out there. So it isn't until that last month where the time decay is going to really start eating into the value when you're not getting the move you want. But I'm looking for the big move, meaning that like I'll buy like a $72 call, but I'm going to be making the money when we're at 76 and 78. You know, that's where that big position is making me a ton of money when that major reversal actually sets in. Yeah.
And so why are you doing, say, the 72 call here and that? Further out of the money call, you can buy more of as less.
You could, but there's a trade-off there. I usually want to look at, essentially I just look at the whole options chain. I'll look at, the 72s, 74s, 76, see what I'm getting, how much I want to risk, and that will decide which one I want to buy and what price I want to accept on it. So yeah, you could buy a lot of deep out of the monies, but what happens is if I buy something that's already in the money, sure, I pay more for it, but even if it gets to 76, I make money there. I mean, that's just almost a direct trade-off. The option market is really efficient at doing things like that, meaning it's less likely for me to get to 80 than it is for me to get to 76. Does that sort of make sense? Because since you have a strike price, you want the move above that strike price. All I'm thinking about is how big is this position I have?
Yeah, well, I'm looking exactly at that efficiency. I'm saying the further out of the money I go, the less time value I'll have, so I can keep the trade on longer.
Yeah. But the options market, I mean, it's so many different strikes, so many different premiums. And also the issue is that it's not the best situation in most cases. I don't trade options very often at all, only when I see I'm getting a good deal in the options market. So if I see that, man, I want to buy these 200 or 300 shares, I want that position, I'll pay a little bit of premium, but it'll deal with all my volatility and limit my risk, I may take it. But if the options the spreads are too big or it looks too expensive to me, I just won't bother. But it's all about, I mean, it's all just about the position. Yeah. I mean, in most cases, that's what I'm doing. Very rarely I trade an option unless I come across that option train, see something that looks great, and go, heck, that's a good deal. But like I said, the options market is very efficient. Like they're very smart as far as how these things are priced, because again, we don't know. Remember, the further and further out we get, the more and more uncertain it gets. So if there's a deal you can find in that string, then I'll take it. But it's mostly just buying the shares. But if, let's say, you're a smaller trader and you're trading a $70 or $80 stock, you may get a better deal on that by going through the options market rather than trying to hold hundreds of shares of that stock. And you get the benefit of the limited risk. I mean, I would talk to your option guys are much better at probably getting into all these different strategies you may. I look at it in a very direct way. I'm a directional trader. If I want the position and I'm willing to sacrifice a little bit of essentially profit from the position and just hold on to the trade, but it's a very sort of functional reason of why you're buying an option. I know what I'm paying for is just to hold that position. Because if the market goes crazy, it doesn't matter. You're going to make so much money no matter where you'll actually make more money with the strikes that are already profitable, and you won't lose much money. Because those far out of the money options, they lose money real fast when it gets less and less likely you're going to see a 10% move up in the stock.
Can you talk a little bit about how you manage a stop for this trade if the Larry Williams indicators keep going in a direction that would suggest a sell?
Yeah, so you get in on your crossovers. And your stops, like I said, are outside the recent lowest low. So just stay outside that range. If a true reversal has taken place, you won't trade there. So exactly where the stop is, it's like 70 something, way out of the range.
Let's say price keeps going up, it goes in your favor,
Mm-hmm.
and then the Larry Williams indicators get set up to suggest a sell.
They won't set up to say a sell because that indicator isn't going to switch. You know what I mean? Like the market accumulation index, because it works on these such long-term divergences, will not switch. So all that's going to happen is I may get a chance to take profit if I get maybe a sell signal from my overbought, oversold. That's a great time to go ahead and take some off the table and then try to buy back at a lower price. And that's where you come in, use predicted lows of the day, use the triple crossover, 18-day level. Because we know that if a market reverses, it's going to do something very predictable. It's going to have a short-term cross, then it's going to have a medium-term cross, then you're going to get your long-term cross, and then your triple crossover is going to become supportive. So how I view it is a lot of this is very dynamic as the trade moves forward. But I know that I'll be buying from here when my crossovers come through. That's when I start buying. But again, I can take profit along the way. I can take half my position off and try to buy back at predicted lows. I can try to, once if I get in down here at, essentially when the crossover comes through, I can take some profit at this level, try to buy back at a lower price. I mean, there's almost an infinite amount of possibilities, but my stops are always outside the lowest low all the time. I don't move them. I'm in there. I'm going to deal with whatever volatility comes from the market, but I'm willing to adjust that position as it moves in my favor. But I'm always going to keep some of it on. Does that make sense? Meaning, like, you could buy 200 shares. You could buy 200 shares when the crossover comes through. Your stops are well out here. You get some move up to a predicted high or a level that you want. You take 100 shares off, put the order to buy back another 100 shares at a lower price. I'm already committed. I'm going to be long 200 shares, let's say, and all my stops stay here all the time. So as the course of you taking profits over that trade, you're decreasing your overall risk on the single position. If you take $100 out of the trade, take it profit, put it in your pocket, now you've essentially decreased all your risk $100. If the market continues higher, you still got a little piece on, you'll ride that big trend, but I still have that other piece that I can add back in if I want, with those stops, again, well outside the range. Does that make, I'm not going to run tight stops. There's no tight stops in this at all. If I need to get out, I'll get out on signals from the trend reversing, but those stops aren't going to get me out.
That's what I mean, the signals on the trend reversing. So like if there was a distribution that was divergent relative to price going up and it was overbought.
Yeah, I mean, this probably isn't the best example right now, but a good example would be something like silver standard. So you got into the market here on a crossover, the shorter term crossovers, where'd you get in? Or let's say you get in on the longer term, you buy here, then you get overbought. And it says, okay, well, take some profit above that level if you can, but try to buy back in because your bias is long. You're always just going to keep adding longs as long as you see otherwise. I mean, so you can trade this market as long as you want. Just make sure you're always going long, and you can run your stops well outside the range. I call them catastrophic stops because they're only there if a catastrophe happens and the market just completely collapses, but it doesn't do that often enough to warrant keeping your stops well inside of that range. So I'd rather just say, okay, well, if I'm going to risk $1,000 on a given position, and let's say I buy, 500 shares or whatever, and that gives me $500 of risk because I'm running a dollar stop, I can add 500 and take away 500 and just keep going long. As long as your short-term signals say buy, that's when you can add that position back on. But what I'm saying is, this gets into what type of trader you are and how often you want to be in and managing a position. You could just buy here, set your stop, forget it. Once it moves up, you can move your stop to break even and then just go find more trades. But when we get into the shorter term trade management, I want to be there where I'm buying the market. When my neural index gets negative, I'll try to buy at lower prices, but I've always got a position on there. You want to hold on to the market as long as you possibly can because you're expecting a 2 or 3 month reversal. So you could take some profit here, you could try to take a little bit of profit above that price level there, but you're always going to be long. You're always going to have that position still on to ride the trend. I don't know. You just have to understand that these are less reliable signals to sell because they're happening in the context of all this major reversal 2 or 3 month bias. Does it make sense?
Yeah, it does. I'm just wondering about when your bias switches.
It doesn't. Because you got to remember, if this keeps trending up for 2 or 3 months, you can move your stops to break even. Eventually, we're getting to more shorter term management techniques, but then we know our triple crossover becomes supportive, so you can move your stops, move them up with the market. But, that kind of just gets into kind of nuanced management techniques, but this is it. If you know you're long, you formed that major bias, and you know that, heck, your neural index that's 80% accurate is saying you the next couple of days expect strength, expect weak, and now it's saying strength. If I get a sell signal and a neural index negative, well, that's a good sort of try to maybe buy at lower prices, but you're never getting out of your long position completely until your stop gets hit that may be trailing. But by the time you're 2 or 3 months in the trade, you got so much room to trail that stop and keep it well outside the range, using this triple cross or just kind of trailing it up. But over the course of that, what you can be doing is buying and selling, buying at predicted lows, selling at predicted highs. Just keep adding to positions over those subsequent 48-hour periods that the neural index is in favor, knowing that, hey, I've got this 2 or 3 month bias. And if the market reverses and the neural index gets negative, you're not going to be adding those additions back on. If the market just keeps telling you expect lower prices over the next 48 and then you get your crossovers, wait until everything lines up again and then try to buy again. But what should happen is knowing that you've got a 2 or 3 month time frame to buy, then go in and use your neural index for the 2-day stuff. Knowing, hey, over the next 48 hours, do I want to add to this? And when it's up at a 1, that says over the next 48 hours, be a buyer. But if you come with just a long-term strategy, you're probably only going to take one position and not try to manage it along the way. But what I'm saying is I'm never taking a trade ever without all of these other things ready to go. And so what that allows you to do is for those, to really just have conviction and make sure you're doing the right thing because, like I said, what will happen is when the neural index is up, you'll be buying over the next couple days. When it's down, you'll either be buying at much lower prices because your bias is still long and it's telling you expect that weakness, or just get out of the position and wait until that neural index gets bullish, then start buying again.
Matt, what's it look like when to tell you your 2 or 3 months is done? It's time to
By that point, you should have made money on the trade. I mean, if you,
not trade anymore in that trade.
the only way that I would say don't trade it anymore is if you actually see the divergence setup exactly the other way. Like if you get to a point where Silver Standard Resources looks like Harley Davidson, and you see those big divergences now going against you, then I would say, okay, get out of this thing. But otherwise, just ride this thing as long as possible, because most of them do last 2 or 3 months, but where you can make a ton of money is when they last all year. I mean, you can get into markets like this. This setup happened on crude oil at 110. That didn't last for just 2 or 3 months. You could have shorted at 110, locked your stop at break even, taken, sold 2 contracts, traded one in and out over the short term, left that other one alone, and you're going to make a lot of money. But I want to trade markets and stay in as long as I possibly can. That's what I'm going for. So the shorter term tools in the VantagePoint are going to help you manage those shorter term opportunities, when you should be heavier on a position, when you can add to it. And when you're heavier on those trends, when you've got more probability they're going to move up, well then it doesn't even matter. You can take profits on shorter term time frames, but you've essentially guaranteed yourself to make money on that trade. And so once you've guaranteed yourself to make money on the trade, just leave it alone. Sit on your hands and let that trend just go. It's time to forget about it. Yeah.
Okay, the TSI works the same as this.
You can use it to spot these conditions, and then yes, be very systematic with how you do these things. So you'll see the TSI. It has different parameters and conditions, but you sort of see the same thing.
Show me how to read that.
Yeah. What I do is essentially the same thing here, is looking at the TSI does have different things you'd want to take notice of. You notice the overbought and oversold condition on the top and bottom. So it's not just divergence, like market accumulation is just divergence. That it's only one line, right? All you're looking at is one line. This has more context to it, right? It shows a longer term trend. You will see divergence, but you also even see that there's this overbought condition there as well. So in using this indicator, what I would actually do is I would just focus on the value of the blue line. So that's where I'd see my divergence. So when you see that you've gotten a huge price rise over this time period, and this blue line at many points is actually lower. You see it goes completely sideways and is actually lower by this point. And actually when you look at really the peak of the market, look what it's doing. It's crossed below its level. It's actually gone flat and diverged with price. You've got a low slope here between the blue line here, blue line here. Ignore the black line. So blue line, blue line. Price is up. Blue line value is lower. You're overbought. You've actually got the crossover to the downside. So that's how I would look at a long-term using the TSI and really the same context to find those longer-term conditions. We could look at it on other markets and sort of compare. But the most important thing isn't even the tools you use. It's the context that you're combining all these things in. So you see really the same thing. When this crossover came through, the neural index was up. It's the same thing. Prices have moved lower over these long periods of time. Take a step back, look at these big periods of time where price is lower, but what's happening here? This blue line is not at its low point like price is here. And again, you see when you get here, you've still got these big long-term divergences, just like with the market accumulation index.
So what does that tell me? What?
It tells you that you don't want to keep shorting into this. Once you get to this point right here, it's pretty obvious. You don't want to keep trying to short here. There's no more meat left to keep shorting this thing. It's kind of how you'd view it. And you'd see what really happens over the long term. It doesn't move down much more because you've got these conditions coming in and being supportive. So it tells me 2 things, is that don't expect a huge decline when you see a crossover like this, right? But a bunch of people saw that and go, oh man, we're going to go so far down, let's get in there. Yeah, you go a little bit down, but not much. You're just channeling. There's nothing here. So whenever I see a crossover, I would never want to trade into something like that, right? Where you've got the TSI, that long-term condition saying something's happening here. And then you bring in all the rest of those tools, those overbought, oversold, bring in your crossovers, your neural index, and then trade it that way. One of the great things about understanding and looking at these big long-term time frames, these 6-month charts with these longer-term tools, is it helps you know really what to avoid.
So you could bring that chart back so we could see that point where it's going forward.
Oh yeah, that's a great idea. This is very suspicious. Like when you get to this point especially. So if you saw any crossover in the software, and you saw that, do you want to start trying to short this thing for a long-term move? No, it's very unlikely that you're going to get a 2 to 3 month big move. And all I'm looking for are big 2 to 3 month major reversals in the market. Yeah, I mean, you roll that forward and you see all the problems with any of, relying on any of these shorter term tools, you just see what the problem is. It's not working. So then once all those other things that we went over, the overbought, oversold, your trend, your neural index, when all those things come together at once, well, then you've got an opportunity to trade it the other way. But it's very rare that all those other things are going to happen at the same time. And I don't want to sit around and try to trade Kellogg when it's flopping all over the place. I want to look at thousands of markets, wait for all these things to line up on that given market, and then only focus on that for that 2 or 3 months going forward.
In your mind, though, would you say that this is a good probability that it's going to go up to mid-70s?
Yeah, that's of course. I mean, that's the setup that looks, hey, you've got divergence, you've got oversold, you've got conditions of trend. So you've been able to buy this market down near 72. It's moved up just under 74 so far. But as a trader, you can take a little bit of profit. Take some money and put it in your pocket. Think of breaking the position up into bullets. You got 1, 2, 3 bullets maybe. And you're going to go ahead and get into that market for the long haul. You're going to be there. But then go in with your shorter term tools and say, hey, where should I go ahead and take some profit intraday? Where should I go? Like that's when you can come in with predicted highs and lows and all this real short term stuff and start getting creative and setting up sort of rules for yourself. Like if we bring in predicted highs and lows here. So we're buying back here. Take some profit. Take some profit up here. Take some profit up here. But I'm not going to leave my stops right outside here. This is for the stop question. I'm going to keep buying this market. I can take some profit when we hit these levels and try to buy and add back on that position at a lower price. Whenever I can take some profit and add more at a lower price, I'm making money. You're taking little pieces out of the market as it moves forward. So you see, this is where the short-term stuff really comes in, where take a little bit of profit, put in your order. I usually have a resting order at these big lines that I put in the market. So take some profit when we get up to these levels, and you get these pullbacks and decline, but don't get completely out of the position because we're waiting for 2 or 3 months. That's where the big money is made. But we can come in over the short term, take these pieces out of it to essentially decrease our risk on the overall position. Because at a certain point, you're going to get to where it's like, okay, well, I've already made $500 off coming in and taking these little pieces of profit, and now I can essentially use that $500 to be break even if this doesn't work out. If it does work out, you make a lot of money.
Excuse me. When you do a trade like that, does that mean you put your stop loss at 71 or 72?
We're way out here. If I'm trading we're just getting back to logic here. If I'm trading a major reversal, my stops are outside the recent lowest low.
Okay, you put a stop loss right there.
Yeah, so when these crossovers come through, yeah. When that crossover is going to come through, you need to be outside of that.
Okay.
If the reversal's right, we won't trade there again. It's a reversal. It's reversed. It's not It's going to start reversing. It'll go all over the place in this range, but you see what happens. The reversal sets in, you hit a higher low, and actually bounce off that level and move higher.
And you put your stop profit right above.
Stops are always way out here. Because remember, over that short term, if you're going in and managing the trade, you're decreasing your risk when you're taking that money out of the market. You're still, I mean, you're going to make your money when it goes to 80. That's where you're going to make your real money. But over the course with our short-term tools, what we can do is kind of take a little bit of profit, take essentially the risk, how much money we are able to lose out,
So that's
and use it to take a bigger position or decrease risk.
when you express that trade, it's an option.
What do you mean?
No, no.
If you, let's look at this real close here.
I want to say something. People are confusing stop losses with getting completely out, like when you
Yeah, I mean, what I'm talking about is you're trading a 2 or 3 month major reversal, meaning you need to be in that market.
you don't want to stop out.
Go long with conviction, make sure that you're still gonna capture that move and make money if you're right in that scenario. But over the course of this, if we get in on this crossover here and say we're gonna start buying from this point on, we can then go in with these shorter term tools and sort of scale some of the position off if we want. And there's almost an infinite amount of ways that you could decide to do this. I mean, you could buy 200 shares and wait until you get overbought and then take off 100 shares and try to buy back at a lower price. If you're even shorter term, then you come in and you're constantly putting orders at these predicted high and low levels, knowing that heck, when the market moves up to that level, I take 100 shares off, but I still got the other 100 shares on with stops, all the stops way out here. So what you've done is, let's say you make 80 cents on the thing because it moves up 80 cents. Well, you've taken $80 out of the market, and you probably started with a total risk of maybe $71.50 down to $200, $200 or $300 risk, and you just took 80 out of your pocket and tried to buy back in at a lower price. You're always going to have a max set risk, right? You're always going to say this is the maximum I'm willing to lose on a given trade. But you just want to manage it in a way that allows you to take advantage of the accuracy of all this short-term stuff, but when you do it in the context of a long-term window, knowing that I'm going to be in there, I'm going to at least have some position on for the duration of this thing until my stop gets hit down here, I'm long, that's what's going to allow you to make money in the short term, and if you're right in the long term, make a lot of money. Now there is the possibility that, let's say you make a little bit of money, you make $80, you make $1, and then this whole thing reverses and collapses, hits your stops, and you're out. Well, instead of losing exactly what you had when you started the trade, your risk, the 200 shares to here, let's say that's $400, now you're only going to lose maybe $300 because you took some of that money out. If the neural index is bullish, put those orders in, be ready to buy. But you have to sort of combine these two time frames of thinking. And the biggest thing that's going to affect your results is management of positions. And so whether you want to manage those over using your overbought, oversold to get out, when you get over and then you say, hey, I'll take the 100 shares off here, or you want to be constantly having that sell for half your position at those predicted highs. That's fine too.
So when your position gets, say it goes really well,
Mm-hmm.
do you keep your original stop loss where it is?
Then you could consider trailing your stops, and how this would work is essentially, we know how the progression will be on a reversal, right? It'll be the short-term cross will come first, then the medium, then the long-term, and then if we're right, that triple crossover will happen as well. And then once the triple crossover happens, the 18-day level here, this big dark blue line, becomes very supportive. And that's where you can then use that as a gauge of where you might want to put those stops, bringing them up from our catastrophic level and bringing them up. See, I still would, at this point in the trade, you'd still kind of have to deal with this because we're not enough away yet. But you can do that exactly, yes, so that if the market does indeed reverse, you get stopped out, you're done. But in reality, probably your trend, your neural index is going to get bearish, and you can just take some positions off, wait for your neural index to get bullish again, and then add back in. And then what's more likely is when that neural index is bullish, you're actually going to get immediate trend working in your favor because you've already essentially been proven right for quite a long period of this trade. So you're always going to go through that trade for that 2 or 3 months with a maximum amount you can lose, and never exceed that maximum amount you can lose. But know to keep buying and trailing those stops and stay in for the long haul, and how we can manage those positions to essentially decrease risk and be heavier at the right time is these sort of tools. So if you recognize here that, hey, the triple crossover is crossed, well, that says, heck, if I want to be long, I can buy at this 18-day level. I've got this level to buy at as well, and my predicted low levels are great places to buy. But you know you're only going long. It's your only option. Go long. That's where your convictions are going to be at. So if you're going to be long, have your orders waiting. If you only have half your position on because you took some off, keep trailing up, and whenever you get that dip in the market, you're going to get picked up for some more and get that likelihood of that 48-hour neural index catching that reversal, that trend continuing, and you making money. But the biggest thing is, if you can, again, understand that, use your short-term tools here. Use them. Use the neural index for 48-hour periods. Use the predicted highs and lows for profit targets and where to add to positions, but only when you have all of these bigger, longer-term conditions on your side. It's so much likely that these sort of trades work out. Yeah.
Could you expand that to a 1 year?
Sure.
Please? And right there on, right around 720, you see it peaks out right there. We've got the Williams on there as well.
Mm-hmm.
And you can see that the charts are close together. They're looking really good right up to that point. Both Williams. You can see where those are, the divergence is very close right in there. It's looking great. That's 6, you go up to 720 right there, yeah, really perfect. You can see where the divergences are very close, it's looking good.
Mm-hmm.
Did you see anything in there that would have predicted moving forward into the future, where all of a sudden this is gonna do a downturn?
No. But the way I'd manage a trade, my indicators would never get me into a market like that unless it's much earlier. So you're only giving back realized gains at that point, there's nothing that's going to tell you how long the trend's going to go on. That's where we're getting to the predictions way out into the future, that there's nothing that can really do that. But if we use our shorter term, but look how quickly actually, so you come back a little, you go sideways, you're tanking. So that's telling you what? The bigger moves over the next few months are now going lower. So what's the most helpful here, and we haven't even really gotten to this, is the process. Because the process is going to make sure that you're only getting into markets for your initial entry when all those conditions are aligned. And then as that market goes, anything can happen, but because you're interacting with the market in that very specific way, something like that unexpected happens and you're giving back realized gains or unrealized gains at that point. And in that situation where something happens like that, if you were long, you would have already made quite a lot of money.
You need to get out fairly quick.
Yeah, but you actually even see that if you were with that long-term position holding on, this does a great job of telling you this may not last. So even when we're channeling here, if you're still holding on to that position, this is really sending you signals that now the bigger move over the next 2 or 3 months is likely to be to that downside. And that's where we end up.
Use that to show the example of how you use a catastrophic stop up if you were in that long trend early, because I think that would be a good spot.
If you had a trailing stop on that, it would help.
Yeah, you would probably, for me, if you're looking real long term here, you'd have those stops well outside the 18-day. And there wouldn't be much you could do about a drop like that. But I would never be in that situation unless I'd already made a lot of money. It just wouldn't happen. So I don't have a problem with the uncertainty of big sort of drops when the only time I'd be in the market, I would have already been making money for quite a long period of time.
You should have been getting in around
Yeah, that's what yeah, you would have been in long before that big drop happens. Because when volatility picks up, volatility picks up. When you have a candle like this is likely to happen. It's just how it is. I mean, when the expansion in volatility is that severe, you're going to get a lot of movement to the upside and the downside. So if you have this sort of approach, you understand where the volatility should take you, where that market should play, and that's you actually see this with, you know, what happened with the 18-day level. The volatility was really taking this market higher, but where do you stop going down? Right at the 18. I mean, it literally went right to that 18-day level and stopped, because that's where you're playing at that point in the trade. That's what the triple crossover is really good at doing, is measuring that kind of shorter term volatility, meaning that you know it's very likely you're going to play in here. And when those lines get very separated, you know you're likely to play in here. Does that make sense? I mean, now we're combining a lot of different things here. You know, I mean, you've got your initial entry as your crossovers, only when all that setup is coming through. We know that you'll get more and more support that you're right when that short, medium, long term, and then the triple crossover crosses. Once the triple crossover is that much separation, you're already in the trade. You got in on the short and medium term crossovers long before. So once you get that far into a trade, you're kind of back to the management. And like I said, those are great levels to, you know, add a position to. So even if you had a resting order in Kellogg, knowing that you wanted to buy, where would you have bought some? Right at that 18-day level, and then sort of realized, hey, that addition ain't great. Let me just step aside from that.
Do you have a trading plan for that?
Yeah, that's what I'd like to get into here, is how do we recognize all these conditions to make sure that we're in the market right at the beginning, and so that we can trade this logical progression. Because when we know that that's the progression we expect, we know what to expect from the market. And that means we're going to quickly notice when it's not doing that, when it's not following that script or that narrative that our framework tells us should occur. So let's go ahead and let me get into some of these scans. And this is actually good that I didn't spend a lot of time on this, because as you come to me individually, then I can, you know, we can get into the computer setting up these scans and how this process works. And for me, it's very rigid. I sit down at 6 p.m. in the evening. I run my currencies and my Forex scans straight through all those scans, through that process of looking for these crossovers, finding all these markets that have conditions. Then in the morning, I get up and do the same thing on all the stocks. But you have to remember that when you're very, very selective and you've got a wide number of markets to scan and look for, you know, what'll happen is, okay, well, you take, you know, I maybe take 2 or 3 new trades a week with all these conditions as far as that initial entry, that first time that you're interacting with the market. Maybe those come, you know, 2 or 3 a week. But you're waiting for this you're going to stay in this market for 2 or 3 months. So then what happens the next week? You maybe find 2 or 3 more positions to throw into there. Then what happens the next week? 2 or 3 more positions to throw in there. And then that's when you build essentially, a system, a technique of then how do you not only find those opportunities, but then manage them moving forward? You know, where those stops go, when do you want to add to positions? And that's, you know, I mean, there's a lot to this trading business. I'm just trying to, at this point, give you the framework that I use to protect yourself in the big picture, so that if you want to take any sort of strategy, you can have a mental map and a context of what should I expect here in this given market? What's happening? Is it a major reversal? Are we overbought? Where are we in this scenario, so that you can make an intelligent decision on what your expectations should be for that trade?
So if you're averaging 2, 3 trades a week, are you getting out of 2 or 3 others that have been in for a long time and are starting to?
Eventually, yeah. You would trail your stops up with these trades that work out, and I mean, I'm looking at every single market I'm in every night, taking a closer look at it. But yeah, when the indications get very bearish, you know, hey, get defensive, tighten up those stops. Or conversely, get out of the market, but try to buy at a lower price. Because if I know, hey, my neural index is negative, I still want to be long here, but we're likely we got an 80+% chance of seeing lower prices. Well, that says, management-wise, let me get out and just put an order at a lower price. That's just as good as making money. Yes, not losing money is just as good as making money. All right. So every evening, I do the exact same thing, scanning for short and medium term crossovers. Now, when we get into a lot of this is organization-wise of you're going to have to be very organized with how you set up this process, meaning all these portfolios that you're going to set up, you're going to have one that stocks long, stocks short. You know, you can set them up where both crossovers are in the same scan, and then you will manually switch from the short to the long, or the short term to the medium. Or you can just set up your whole portfolio that way where you just go click, here's the medium term longs crossovers coming through. And then click on here's the short term longs coming through. Here's the short term cross shorts. So I literally have all these scans set up where it's short term crossover to the downside, medium term crossover to the downside, short term crossover to the upside, medium term crossover to the upside, and you just click through them all and the software will filter all that out for you, so then you can just spend the time focusing on the bigger term setups, because you know it's going to do all the crossover work for you. So we've got, let's see, how many markets here? I'm running out of time here, but so there's 166 markets as a services sector. And out of 166 scanned, we get down to 46 that get found. We set our crossover condition to up. Now we're even smaller. Now you're down to 34 markets. Your neural index obviously needs to match that. One condition that I really like to put when you're scanning for these crosses is the long-term difference. I think it's actually the long-term difference trend. And what we're doing here is just really getting into, again, it's just really logic-based here. If I see a short or a medium-term crossover, let me get all this crap out of here. So what I've done here is this is just short-term cross, and you would set up a similar scan for your medium-term cross. And this is the stuff that on the one-on-ones we can really get into and set this stuff up. But if I know that I have a short-term cross, essentially to the upside, what I'd like to see is the long-term difference also supporting that. And the logic here is really simple, and I want to show you this on the chart here. Just, hold on, sorry about this. The logic here is really quite simple in that if a short-term cross is happening, then the long term should be weakening. We know it's not going to be there yet. We know the short term happens before the medium term happens before the long term. But what the difference is telling us is this slope changing? Is that long-term trend also weakening in line with the short-term trend we identified that has actually already reversed? Because if you have a short-term crossover coming, but your long-term difference is slanted lower, that's another mishmash that you just don't want to waste your time looking at. So in the context of this here, we'd have all of these conditions set would essentially show us what we see right here. A crossover to the upside, neural index up at a 1 matching it, and the long-term difference with that slope moving higher. That's going to filter out additional opportunities. But then when we actually start flipping through these charts, and you bring up something like sentiment, apply to all, you know your crossover conditions are already met. So all you need to be doing is really focusing here on this indicator. We know you got your crossover set. So you're essentially just flipping through and saying nope, nope, nope. I say nope here because that's a stuck indicator. It doesn't count for me. But this is really how it works of finding, okay, well this looks a little more interesting. You have your PSI hit, crossover. Then we'd still want to look at market accumulation. But this is how we can quickly narrow down on where are these conditions actually being met in any significant way to match our system. And this is where the art of the fold comes in. You're going to look through a lot of charts and really only be looking for just those opportunities that match. And when you get obviously more and more familiar with this and you bring in your sentiment, they sort of stand out at you. So I haven't done these scans for over Friday, but we know what we're looking for. Yeah, I mean, this is kind of a waste of time going through this right now individually, but you know everything you're looking for for a new trade, an initial entry, for a big market reversal, where to pay your attention. And another thing that I do look for is I look for markets that generally are hitting, fresh new lows. So that you're hitting these lows, you're seeing the crossovers coming through, you're seeing all of these conditions align, and that's where you're going to get that big probability of a major reversal in those sorts of markets.